If you ever feel like you're getting crushed by taxes, you're not alone. Canada has some of the highest income tax rates in the world. But what if you could legally cut your tax bill without shady offshore accounts or risky schemes? Today, I'm breaking down 3 completely legal loopholes that can save you big on taxes, starting with loophole number 1, using a prescribed rate loan to split income. The prescribed rate loan is one of the last legal income splitting loopholes in Canada. Income splitting is one of the best ways for families to reduce their overall tax bill, but the CRA has strict attribution rules to prevent high income earners from just simply gifting money to a lower income spouse to invest. Normally, if you gift to, say, your spouse $50,000 to invest, any income still gets taxed back at your tax rate. So that strategy doesn't work. But with this loophole, you can legally lend them money at the CRA's prescribed rate, which is currently at 4%, shifting investment income into their lower tax bracket. Originally designed for corporate planning, this still works for families if you follow the rules. Here's how it works. The high income spouse lends money to the low income spouse at the CRA's prescribed interest rate. As I mentioned, it's 4%. The low income spouse then invests that money in stocks, ETFs, or other income generating assets. Then investment income is taxed at the lower income spouse's tax rate, reducing the overall family tax bill. The low income spouse then must pay interest on the loan annually by January 30th, or the strategy falls apart. Let's take a look at a scenario where this strategy really pays off. Jim is in a 50% tax bracket while Pam is in a 20% tax bracket. Jim lends Pam $100,000 at the CRA's prescribed rate of 4%, and she earns a 30% return, which is $30,000 in capital gains. At year end, she sells the investment, which triggers taxes. So how do taxes play out? Pam pays Jim $4,000 to invest, leaving $26,000 in gains. Only 50% of capital gains are taxable, so Pam is taxed on $15,000 at 20%, paying $3,000. Jim pays $2,000 tax on the $4,000 of interest he receives. Now compare it to Jim investing it by himself. Jim's $30,000 gain, which is $15,000 taxable, would be taxed at 50%, which means he would have to pay $7,500 in taxes. Total tax savings with this strategy. So taxed if Jim was investing by himself would have been $7,500, and tax paid using this strategy is only $5,000. The savings are $2,500. By shifting the investment gains to Pam's lower tax bracket, they save $2,500 in taxes, money staying in their pockets instead of going to the CRA. And if your income is, say, interest income or dividend income, your tax savings could be even more potentially. Now, you might be thinking, well, a 30% return sounds way too high. And you're right, sustaining that 30% return over the long term is highly unlikely. However, achieving it in a single year is entirely possible. For instance, in 2024, the popular Vanguard VFV S&P 500 ETF delivered a 35% return. This example more illustrates the best case scenario for this income splitting strategy. Now let's go over the risks and downsides of this method. First, you have your investment risk. If Pam's investments underperform, the tax savings won't make up for the losses. If the market is booming, like when she earned a 30% return, the strategy works great. But what if it crashes? If Pam only earns, say, 2% or even loses money, she still owes that $4,000 in interest to Jim. That means she might have to dip into savings or sell investments at a loss just to make the payments. Meanwhile, Jim still reports the $4,000 as taxable income, even if Pam didn't profit. The next big risk is the prescribed rate can change. If the CRA raises the rate, it was 1% for example in 2020 and now it's 4%, the strategy becomes less effective since the loan money needs to earn more than that to be worthwhile. Then you have the strict payment rules. Pam must pay the interest on time every year. If she misses even one payment, the CRA cancels the entire strategy and all the investment income gets taxed back to Jim. This strategy works best in a low interest rate environment, and with rates starting to drop in Canada, it could become even more attractive in the future. If this tax strategy piques your interest, check out my free guide on 7 powerful income splitting strategies to legally reduce your tax bill. The link is in the description on our website. Loophole number 2, extracting tax-free money from a corporation via a CDA. This is a loophole I personally used when I sold my previous website and YouTube channel called Wealth Awesome last year. If you haven't seen my video about the wild ride of me building and selling my former business and why I started this new Blueprint Financial channel, go check it out. But basically, I was able to pull out tax-free money from my corporation using something called the capital dividend account, or the CDA, a strategy many business owners don't even realize exists. The CDA is a special corporate account that tracks the non-taxable portion of capital gains and allows business owners to withdraw that amount as a tax-free dividend. Normally, if you take money out of your corporation, you pay personal tax on dividends or a salary with payroll deductions. But with the CDA, certain withdrawals are completely tax-free, which is why this is such a powerful loophole. Here's how it works. Your corporation sells an asset. This could be a business, stocks, real estate, or even in my case, digital assets or other capital assets. Then only 50% of the capital gain is taxable. Since in Canada, only half of our capital gains are taxable, while the other 50% remains non-taxable. There was a 2/3 inclusion rate proposed, but it probably won't be in place anymore. Then the non-taxable portion goes into the CDA. That tax-free 50% is credited to the capital dividend account. Then lastly, you pay out a tax-free dividend. The business owner can withdraw the full CDA balance tax-free. So here's an example. Let's say Alex sold a digital asset within their corporation and made a $200,000 gain. Normally, if Alex wanted to take that money out as a regular dividend, he'd be taxed on the full amount. However, because only 50% of capital gains are taxable, the other $100,000 goes into the capital dividend account, or the CDA. This means Alex could pay himself a $100,000 tax-free dividend, keeping the full amount with zero personal tax owed. And without the CDA, he would have had to pay personal tax when withdrawing those funds, which significantly would have reduced the final amount kept. This is why proper corporate tax planning is crucial for business owners when selling a major asset. It can mean a difference between keeping more of your hard-earned money or losing a big chunk of it to taxes. Here are some key considerations and risks though. First of all, it must be properly tracked. The CDA balance must be properly recorded and reported to the CRA. If done incorrectly, withdrawals can be taxed as regular dividends. Then it only applies to certain income. The CDA only applies to the non-taxable portion of capital gains, life insurance proceeds, and certain capital transactions. Regular business income, for example, does not qualify. It also requires careful corporate tax planning. If you're planning to sell a business or an asset inside a corporation, you should probably be working with a tax professional to maximize your tax-free withdrawals and to set up the CDA correctly. And this is something we help clients with all the time. Check out our business services on our website to see how we can help you maximize your tax savings and structure your CDA the right way. Loophole number 3. Turning your mortgage into a tax-deductible loan. In Canada, mortgage interest isn't tax-deductible like it is in the US, but there's a strategy to convert it into a deductible investment loan over time. By reborrowing against home equity and investing in income-generating assets, homeowners can legally deduct the interest. This works because the CRA allows interest deductions on loans used for investments, but not on mortgages. By recycling mortgage payments into an investment loan, homeowners take advantage of a legal gap in the tax system, making this a powerful yet unintended tax loophole. And here's how it works. First, you have to make your regular mortgage payment. So each month, a portion of your mortgage payment reduces the principal. Then you can reborrow that same amount through a HELOC. If you have a readvanceable mortgage, the amount you've paid towards the principal becomes available in a home equity line of credit, otherwise known as a HELOC. Invest that borrowed money. The funds from the HELOC are used to buy income-generating investments like dividend stocks, ETFs. Then you can claim a tax deduction on the HELOC interest. Since the borrowed money is used for investments, the interest on the HELOC is tax-deductible, reducing taxable income. Then you could repeat this process monthly. Over time, your mortgage is completely converted into a tax-deductible investment loan while your investment portfolio grows. So here's an example. Let's say David has a $500,000 mortgage and makes a $2,000 monthly payment. Out of that, $800 goes towards the principal. That $800 is now available in his HELOC. He borrows that $800 from the HELOC and then invests it in dividend stocks. Over time, David keeps reborrowing every month and gradually converts his entire mortgage into an investment loan. The interest on the HELOC is now tax deductible, reducing his taxable income each year. David is now simultaneously investing and reducing taxes. It sounds great, right? But there are some pretty big risks and downsides. First of all, there's the interest rate risk. HELOCs have variable interest rates, meaning if rates rise, borrowing costs increase. If HELOC rates jump higher, this strategy could become much less attractive. Then you have your market volatility. If investments underperform or lose money, you still have to pay interest on the HELOC. Even if your portfolio drops, you're still on the hook for the loan payments. As an example, if David's investment portfolio earns 10% in 1 year, he benefits from both investment growth and tax saving. But if the market crashes and his portfolio loses 20%, he still owes interest on the HELOC, which could put him in a dangerous financial position. Discipline is required for this. If you don't reinvest the HELOC money every single time, or if you use it for personal expenses instead of investing, you lose the tax deduction and could get into serious financial and tax issues. Then you have your CRA scrutiny. The CRA requires that borrowed money must be used for income generating investments. If the investments don't generate an income, like a growth stock with no dividends, the tax deduction could be denied. This strategy is most effective in a low interest rate environment when the cost of borrowing is low compared to potential investment returns. With interest rates starting to come down, this could become more attractive in the future. However, it's certainly not a strategy for everybody. I highly caution against this strategy. You need to be very comfortable with leverage, investment risk, and have strict discipline to make it work. These are all legal tax loopholes, but tax laws change over time. What works today might not work tomorrow, so before making any big financial moves, always check the latest CRA rules. Better yet, let a professional handle it for you or guide you in the right direction. And that's exactly what we can assist you with here at Blueprint Financial. Visit our website to see how we can help you pay less taxes and keep more of your money. And if you found this helpful, hit like, subscribe, and drop a comment on which of these loopholes stood out to you the most and which one you might give a shot.